Well, hello everyone. Don Garmin again. This month we've got May 2026. We're here with Dan Murray and Jackson Vickers. Dan is joining us again. I got some nice texts after last month's quick video suggesting it was nice to see some new faces. So, Dan, welcome back.
Oh, thanks.
Um, yeah, it was also suggested this is a sidebar and curveball, but somebody said, well, what you guys should do is debate a topic. And so I will respond to that sincere request in the following fashion. I feel like there are so many avenues and ways nowadays to see vigorous debates. I would prefer to leave this little weekly or monthly check-in on a positive, more like a observation from the things that we're discussing, things we're hearing from clients. And so I don't think necessarily we'll be debating on this monthly video, although you guys are always free to disagree with me, as you often do, from time to time on whatever topic. So anyway, I just wanted to throw that out there. My only commentary to begin this month is last month, as we went into April, and for those of you who have followed along for a long time, January, April, July, and October are the big earnings months. And I was nervous for all the reasons that we highlighted last month about this particular earnings season and feeling like with a war or a whatever we're calling it, excursion, incursion, whatever we're referring to it as at the moment, this would be a great opportunity for CEOs who weren't highly confident in their future to talk down future expectations, to highlight caution ahead. And I thought that would be a challenge. And so, Dan, I know you have some things that you're going to contribute that explain why that didn't necessarily happen. But fellas, I can say if I read you guys the headlines that we're looking at nearly every day 9 weeks ago and said, gas was going to go up 50% over the next 9 weeks. Where's the market? I don't think any of us would have said, flat. So I can speak for you guys when I say we're all scratching our heads a little bit, but I think Dan, you've got some numbers to explain what is probably underneath all of this that's keeping us together. But I think we can keep it relatively short today. So Dan, why don't you share what we were chatting about this morning, if you
Yeah,
would?
I was just doing my homework yesterday for the investment committee, and it was a quietly a historic earnings season. We had 86% beats, which is, that's over 12% higher than the regular beats. Um, you have, and then more importantly, the earnings
Sorry, Dan.
estimate.
Let me stop you just for a
Yeah,
second because I know we can go real quickly into
yeah.
jargon. And from our perspective, what analysts do as a group is they look at a business and they try to figure out what it's going to earn in the future. And that's really what the job of an analyst is to understand a business and to try to figure out what they're going to earn in the future and discount it back to the present and establish whether or not it's a good value to buy or sell. What really drives stock market performance isn't necessarily them meeting the expectations. That's what everyone expects them to do, is meet the expectations that they have set. But when companies are outperforming their own expectations, that's when they have tended to be rewarded. And conversely, when they underperform or miss their expectations, I think you've got a little comment on that as well. This has been extremely penal for that group of companies that is underperforming. But anyways, keep going with what you were
Yeah,
saying.
so the reported earnings, especially from the breadth of the S&P 500, 10 out of 11 sectors outperformed what these analysts thought they were going to do, and it just wasn't the seven wonderful stocks that we've talked about for years and years, but really from top to bottom of these largest cap companies in America, and not only did they outperform what they were expected to do this quarter, but their guidance also pointed, which is what they'll say, hey, this is what you should expect to see down the road in the next couple of quarters. Their guidance, um, started out at around 15% uh, in terms of profit margins, and it guided to 21.3.
Mhm.
So, it's sustainable is kind of the
So
view
how
of.
to interpret that is the businesses are growing in a sense faster than they were, and they're more profitable, which is
Yeah,
the sort of holy grail of, being long a stock is it's growing fast and it's getting more profitable. That's the highlight of a
yeah,
very good business. Jackson, it looks like you had something to add.
Yeah, well, I want to say briefly just on the earnings calls that we all listened to last week. The big point that I noticed was a huge expansion up to about $720 billion of capex from the largest hyperscalers on AI infrastructure. And why that's particularly important to me is that's now over 2% of GDP expectation
Mhm.
for this year. So if that's going to be over 2% of GDP, then that's going to be a very meaningful chunk of GDP growth for this year and moving forward. And so if you kind of move that along the supply chain, everybody's compute constrained still, which means that they're actually energy constrained and they're memory constrained. And so all of this expansion is going to benefit a much larger depth of companies than we anticipated it would initially.
yeah.
So let me throw the fly in the ointment of that topic or that comment, which is the Fed's job, their mandate is stable prices and stable employment, at the sort of GDP or at the nationwide level. And everything Jackson just described isn't it's not generally deflationary, or it is inflationary. And so where we came into this year expecting the Fed to cut twice this year was the expectation a week 4 short months ago. Now the expectation is no cuts, perhaps no activity for the entire year. And obviously, we're in transition from the old chairman to the new. So there will be plenty of headlines and fun commentary and insults hurled all around, I'm sure. But that's it's creating tension within the Fed, as we saw just this week, where there's a lot of dissent as to which way the forward path of the Fed ought to be.
Yeah,
Does that
and to
sound
that
fair?
point, Don, the secured overnight financing rate is down year to date. I believe it's down over 6%, but both the 10 and the 30-year Treasury are up. And so I
Yeah,
think
the
that
30
that
crossing five, which is a little bit of a troubling number for a lot of folks.
right, so mortgage rates and refinancing rates, especially if people are going to try to sell and move, still remain really elevated. So you're going to see a pretty frozen housing market at least for a while, as we have seen.
No
Yeah,
doubt, for a long
yeah.
time now.
To touch on a couple points that
Mhm.
first off, the Fed is the most disjointed it's been maybe ever. We have the chairman rolling off, and he's going to stay on there for it's the first time the chairman's rolled off and stuck around since 1948.
Yeah.
Um, yeah, it'll be pretty interesting to see the new regime and how they present to the public. We talked about that pretty robustly at the investment committee last week.
Hmm.
And then the other thing was that we touched on was the you know the capex spending on AI is through the roof, but the real bottleneck now is going to be um, is power, and the all stars in this earnings cycle were the people that supplied powers to these data centers, and they were the ones that completely outperformed what the analysts thought. And in fact, on the way in today, I just heard on the radio that the the North American Electric Reliability Corporation, who's a nonprofit that looks after the energy, or the electrical grid for the entire nation,
Hmm.
set out a warning saying this summer they're really worried about intermittent drops because of the extreme demand from these data centers,
Hmm.
which it doesn't surprise me if you look at what the be it Amazon or Palantir or any of these AI companies, they're spending a ton of money and they're making a ton of money. Their
Hmm.
revenues are through the roof. So obviously AI is being adopted wholesale throughout the entire country, and if not the world. So
Yeah, and let's end it on this note, which is the real bull case for here forward would be that as they're putting up these data centers and we're all getting more used to these tools, which they're making everybody in all parts of the supply chain more productive, the downside of this could be near-term job loss. The upside of this could be a whole lot more productivity in aggregate, a whole lot less wasted time, a whole lot more things getting done, and maybe innovation and maybe discoveries and maybe all the things, that we cannot easily trace at this point. But that is certainly the promise. And I think just the three of us, I look at how we've talked the last 3 months. I feel like we're all using tools that we all sit around and talk about it. These would have taken us weeks, and we would have spent gobs of money to produce the thing that you produced for the investment committee last week, Dan. It's just it's pretty shocking how good and easy some of these tools are to use. And if we can all get them to be productive for us, then there's a good there is a good future ahead once we navigate some of these rocks in the river here. Sound fair?
sounds fair.
Absolutely.
Yeah. Yeah.
Okay, good. So we're through Q1 earnings. We're into May. June tends to be quieter. There's this old bromide sell in May and go away. That hasn't worked for a long time. But so hopefully we can get a quiet couple months. July is our next big earnings season. Next month, we may do something a little different and bring in even some different parts of the team to talk about what they're working on. Jackson, I know you've been extraordinarily busy on the financial planning stuff. And so hats off to you for that, for keeping that all moving forward. So appreciate your efforts there. Last thing I'll say is one of the things I would love our clients to be comfortable doing, and some of you do, but a lot of you don't, is where you have pain in your lives. We hear a lot when I say to clients, we can handle that. We do that, or we can do that. And I've heard many times, too many to count, oh, I didn't know you did that. And so we really are a full service wealth management shop. And, with as many people as we have now, there's a lot of capacity to work on problems, be it the 401k at your business, long-term care insurance, just questions about your general financial planning preparedness or readiness, all of these things. If it's creating pain or discomfort for you in the financial realm, just reach out to one of us and say, hey, do you guys, anything you can do to help? And generally the answer will be, perhaps I think we can help. So we'll leave it at that. So on that note, happy May, happy late spring. Are we mid-spring? We're not summer yet.
Yeah.
Mid-spring.
Yeah.
Yeah.
I know, can tell
mid-spring.
from my allergies, we're definitely in something. So something's happening.
Yeah.
Anyway, fellas, appreciate you. We will see you all soon. And if you need anything, please reach out to one of us. We appreciate your trust as always, and we'll talk to you soon.